Hello, good morning, traders. It's Wednesday, it's the middle of the week, and as usually on Wednesdays, I have a session about OPOS. This is a strategy for working people. I'm just joining the beginner's room. Okay, so OPOS. The name OPOS comes from only pending order strategy. It's a strategy which I call an after-work strategy because it doesn't consume so much time as, like, for example, scalping or day trading. This strategy is based on supply and demand zones. This is a strategy for people who don't have much time for trading, but they still would like to spend 2-3 hours per day of their free time to analyze the markets and place pending orders, which will be triggered when the price reaches the level predicted by the analysis. The advantage of the strategy is that the pending orders can be placed in your free time and they will be executed when you are at work. And in that moment, you wouldn't have any opportunity to open that trade. Even maybe not chance to have contact with the market because if you're a driver, for an example, of a bus, you cannot watch the Forex market while you are working, or even if you are working at school or in a shop. So pending orders is the best solution because you put them much earlier and they'll be executed when market is at that level. The theory of the base of the strategy is the theory of supply and demand zones. The theory says that there's always a group of sellers and a group of buyers, and as long as they agree with the price, the market is stable, it's moving, let's say, the charts are flat. The price is not jumping strongly up or strongly down. The problem begins when there's imbalance between buyers and sellers. Such an imbalance we often see on the commodity market, but also on the currency pairs. Here's a picture showing how much can change the price just because there's a lower demand or higher demand. All depends on the balance. If there's a problem with sellers, then of course price goes up. If there's a problem with buyers, the price goes down. This was a specific situation. Probably you remember the period of pandemia, the coronavirus, and many countries closed. I mean, they were not going to, people were not going to work. There was a big reduction of travels, and people were staying at home. Demand for oil plummeted significantly. If you stay at home, you don't use your car, you don't need oil. The same was with industry. Industry was also producing on not as usually. So it led to reduced demand and very, very normal supply at that time. It happened that the oil was at the price of $4-5 per barrel. But when the things came back to normality, price also started going to normal levels. And as you remember, in 2022, Russia invaded Ukraine, and there was a risk that the pipelines which are running through Ukraine will be destroyed or will be closed. And there were concerns about supply disruptions. Led to increased demand. Especially Europe started buying oil wherever it was possible, and price of oil jumped to $130 per barrel. And what's the most important in this picture is that it's not a matter of the product, it's the matter of supply and demand. It's the same product costs $5, and the same product can cost 2 years later $130. This is a typical sample of how important is the balance between suppliers and demand. And the same happens also on the forex market. If there's a demand for a currency, then observe we observe that the currency is getting stronger to other. If the people don't like that currency because it's not desired, that its value is losing. We observe this even now when we look at the chart of yen, which is very weak at the moment. We can take a look here. Let me show it. This is the situation which shows us that market doesn't want yen. It's losing for many years. Last 5-6 years, it's non-stop losing against other currencies. Why? Because if you keep your money in dollars, you'll get much better return than if you keep it in yen. At the moment, if you keep your money in the US bank in dollars, you will get 3.5%, maybe 4% per year. And if you keep it in yen, you will get 5%. So it's absolutely logic that you will keep it in dollars. And as long as the Bank of Japan will not change their monetary policy to more hawkish, as at least informing that in the future they will hike the rates, yen is the biggest loser, and it will be a big loser if they don't change their approach to the market, to the monetary policy. Anyway, this is also a sample how wrong monetary policy leads to such problems. And nobody can change it as long as the Bank of Japan will not understand that the world doesn't want this cheap currency, which is not giving big returns. What worse, we also saw that Japan also has fallen rapidly. So also there's no desire, no people want to buy the Japanese shares. I don't know how far will it last, but at the moment the situation is not good for yen. Even the economy is not so bad as some would expect. But coming back to the theory, how can we use this in our trading system? Hello, Ioannis. Hello, Danushka. As you know, we are at the moment on the YouTube, so I'm making an introduction for people who also didn't have a chance before to know this strategy, so we have to spend a few minutes here. Theory, and then we go to our charts. So how can we use it? Well, the idea of supply and demand comes from this what I showed you, that definitely if you see price moving quickly up from some area, it means that here we had a lot of buyers. So we can say that if you see something like this, you can be sure that here's a big demand, and this demand pushes the price higher because the supply is non-stop at the same level, but the growth of amount of customers makes the price go higher. But when we see something like this, here we know that there's no more buyers, but there are more and more selling. Because, if price is good, everyone wants to sell, and this makes the price go down. So this is the theory says that what's important in our strategy is to find those areas where the market is moving strongly up or strongly down. And I am using an indicator which is showing those things. And this indicator is drawing those supply and demand. So for an example, if I have a clear chart where I marked only a support and resistance level, which is absolutely something different. It's different than supply and demand because those levels here are not created because someone started buying or selling. We call those technical levels. Very often it happens that there were some news which make the market move a bit stronger, but then people quickly take the profits and the market is reversing. A level like this is called support and resistance, and it's created by the market in this way that first they try to break a level from the bottom, and then they cannot break it down. So from this moment on, we can call it uh, support and resistance level. But supply and demand zones, those are different things. Supply and demand zones, those are those here, what you see here. When we see that market is rapidly falling from some area or rapidly growing. And those areas are kind of a confirmation that this is a buying or selling area. For an example, this one here shows us that someone was very strongly interested in buying, and that was driving the price higher. And when the price comes back again here, we see that again it is moving up. So if we properly identify those zones, we can use them in our trading. As I mentioned, I'm using an indicator which is drawing those zones, but of course you can also draw those zones yourself manually. But I think that the indicator is doing the work very well, so I don't draw them manually. I just believe that the indicator knows what he's doing. And why those zones are created? Well, here's the explanation. Because, as I mentioned, support and resistance are created for various reasons. Supply and demand zones are only created by buying or selling transactions. And those are made by large players, banks, hedge funds. Big financial institutions, they deal with huge amounts, and they cannot execute their orders at once because of the liquidity issues. So big institutions divide their big orders to smaller pieces, not to disturb the market too much. And that's why those zones are created. How can we use this strategy in our trading? Well, we can plan, for an example, a sell limit or a sell stop in a place where you expect the price to make something special. And in this case, when you look at this, you can see, okay, this supply zone drives the market lower. It can repeat this price action again here. So it might be opportunity to short. But sometimes when you see a zone from which the price already moved twice or maybe even 3 times, there's a risk that they will break through because it will mean that there's no more money here. Let's say that someone distributed his big order on 2 pieces, 50% here, or 60% of the zones on that zone, and 40% here. Then there's no more money in this area. So next time when price comes back, they can break it through. So you can put a sell stop expecting that if they break it, you will have an opportunity to join the market as soon as possible. And those things can happen while you are at work. That's why pending orders is a good solution for this type of trading. We can use also this strategy when we expect a breakout from a consolidation. If you see a consolidation like this, you can put 2 pending orders. One is for a buy stop, second for a sell stop. And after the breakout happens, one of your trades will be activated because you never know which direction they will break. And here's a picture showing the difference between support and resistance and supply and demand. As you see here, we have very strong supply zone from which price was pushed down, and here we have from demand. But here we don't have a support or resistance level. It's just a zone. And here also you can put a buy stop, sell stop, and sometimes you can also predict the direction of a breakout, because when you see something like this, okay, and you see that there was a really area which was rejected, because this lower wick shows us that nobody wants this price. It's cheap for the buyers. It's so cheap that they quickly buy everything at this zone. So there's a big possibility that the pressure of the buyers will push the price above this short-term consolidation.